Today, 20% of the S&P 500 is made up of three companies: Apple, Nvidia, and Microsoft. These three companies have posted incredible returns over the last few months, driving the majority of the recent rally on the S&P 500. Meanwhile, less than 50% of stocks within the S&P 500 have actually been moving higher over the last 50 days. Many people are pointing to this weak participation in the market as evidence that we're about to see a large market crash. We're going to see if there's any truth to this by diving into history, looking at the health of these three massive companies to understand how long this can continue. And I'm also going to show you why this is a very important signal for the US economy. By the way, I want to wish you all a happy 4th of July. I hope everybody had a great time yesterday. For Independence Day, we are doing a special 30% discount on our membership, something we rarely do. So if you've been thinking about trying our membership out, now's your time to do it. The reason for which investors get worried about weak market participation is that it makes the stock market vulnerable. When many stocks participate in a rally, it provides a foundation. When less stocks are participating, the foundation becomes weaker and the more vulnerable the rally is to turn around. A great example of this is 2010 and 2011. Throughout the initial stages of this rally, a lot of stocks were participating, with over 90% of stocks within the S&P 500 moving higher. But as time went on, the S&P 500 continued to move higher, but the number of stocks participating in the rallies grew smaller and smaller. Eventually, the S&P 500 broke down and corrected very quickly by around 20%. The exact same thing happened in 2014, 2015. There were many stocks participating in the rally in November of 2014, but although the market continued to move higher over the next year, the number of stocks that were participating in that rally grew smaller and smaller. Eventually, the S&P 500 broke down and quickly corrected by almost 15%. So we clearly have examples where weak market participation was eventually a problem for the market, but it would be unfair to say that's always the case. The bull market that occurred in 2017 is a great example of that. You had multiple instances throughout that rally where only 50% of stocks were actually moving higher. These moments often turned out to be quite brief, with participation eventually recovering. And we had the same thing in 2021. If you remember, back in July of 2021, we had less than 50% of stocks participating in the rally at that point. The S&P 500 barely corrected 2% and then continued to move higher, with market participation expanding again. So there are two conclusions from all of this. First, it's not uncommon to see periods where market breadth is a little bit weaker even during strong uptrends. Secondly, even the moments where weak participation did lead to a correction, it often took more than a year before that happened. In 2024, market participation really started to degrade starting from January of 2024. So it could be that we continue to see this until the end of the year, with the stock market actually continuing to rise during that period. So we have to look at the components that are actually pushing the market higher today, because those are really going to determine whether the market can continue to rise or whether it's about to make a 180-degree turn. Microsoft, the largest component of the S&P 500, has been in a very strong uptrend since 2023, with the stock recently breaking out above a resistance that it had formed between March and May of 2024, potentially indicating that it does have more room to run. If Microsoft fails this breakout, we'll learn something new, but for now, that's not the case. We can say something similar about Apple, that has just broken above a massive consolidation range it's been in since 2022, again potentially indicating that the stock has more room to run. If this breakout fails to hold, that really wouldn't be such a good look. But for now, that's not the case. In fact, we recently sent out a buy alert for Apple to our members as the stock finally broke out above this important resistance line. Nvidia, of course, has been one of the strongest stocks over the last couple of years and in a very strong technical uptrend. It's impossible to predict exactly when this rally on Nvidia is going to peak, but betting against the stock market today also means that you're betting against this extremely strong uptrend on Nvidia. So the truth is, all three of these stocks look unstoppable in the short term. Trying to short the market today is fighting the uptrends on Apple, Microsoft, and Nvidia. And as we've been saying, since the S&P 500 broke out in December of 2023, don't fight the trend. The short-term uptrend on the S&P 500 is extremely aggressive, and the index recently broke out above a key level we've been watching with our members, suggesting the S&P could actually make its way up to the very top of this channel over the next few weeks, maybe hitting our 6,000 point target that we laid out when the S&P 500 initially broke out above this large basing pattern in 2023. But even though the rally still looks strong because of a handful of stocks, we are seeing important areas of the market deteriorating, suggesting that the US economy is weakening. The transportation, consumer discretionary, and financial sectors have all been underperformers over the last few months. Our belief is that the market is heading towards a long-term peak. This is, in our opinion, one of the most difficult environments to be a trader or investor because there's lots of economic and valuation risk in the market. And if you're not exposed to the right areas of the market today, you're also going to get left out. We're doing everything we can to highlight the best trades to our members at gameoftrades.net. Unfortunately, we can't guarantee that our past performance will hold up in the future, but we're doing everything we can to make sure that that's going to be the case.